All right. Excellent, excellent. As you can see, I am not in our usual confines. I'm actually um, in our office up here in the Board of Trade. I'm not down on the trading floor because I just actually got downtown and just didn't have time to get down onto the floor. So here I am up here. It's all good. Today is probably one of the lightest volume trading days in a very, very long time, and um, not just in the equities, but also across. I'm sitting here with Howard Greenberg, and he's saying the same thing in crypto. I'm sitting here with Dan O'Brien. He's saying really, really slow on the future side of things in the ES. So, you know what? That's not a bad thing. That's actually not a bad thing at all for the market. We don't need the market doesn't need to have these kind of big swings every single day. It's great to have a little bit of normalcy every now and then, especially, we're still in the midst of some decent earnings coming out. We got Salesforce after the close today, and then everyone's getting prepared for the Fed for next week. So this is not honestly the worst thing in the world here. It really is not. So today, what I want to talk about, and I'm getting this up on the screen here as we speak. Okay, there we go. I think I got it there. Now I just have to figure out lots of snow here in Chicago. Yeah, it's oh wow. I don't know. That's my window back there, but it's all white and you can't see any of the buildings or anything because it is snowing pretty hard right now. And I think it's supposed to snow like this for the rest of the day. All right, I am just about ready to have this up on the screen here. Sorry, because I am at a new computer. There we go. Okay, let's do it. Can everybody see the screen now? Yeah, Kim, I know. Finally, snow out there. Some nice big dumps in the last couple days over. I know Vale and Beaver Creek area, but yeah, it's about time. It is about time because it has been atrocious at best. Okay, everybody smash away, like away, all that good stuff there. And why do I have this up here today? Why the heck do I have the Greek alphabet up here today? Well, the reason the reason is because we need to understand the Greeks, right? We always talk about delta, we talk about vega, we talk about theta. One of the and we rarely talk about rho, which is interest rate sensitivity. But one of the things that we really don't talk about often at all is this guy right here, gamma. And again, I'm trying to get my drawing tool up here, which never ever works. Let's see, download Epic Pen. So does everybody know what gamma is and why it is important? Actually, and we don't talk about it because for the way that we trade, I would say that gamma does not come into play too often, but it is incredibly important to understand what it is. Okay, and gamma is also known as the second derivative of delta. So everybody knows what delta is, right? I mean, the common definition of delta is that, okay, it is the amount that the value of an option changes as stock moves a dollar. Okay. It is also the percentage that the market is giving to any option at any time that option will expire in the money. So if you've got a 30 delta option, what that is saying is the market right now is pricing in that there will be a 30% probability that option expires in the money and turns into, there we go, and turns into a stock position. Gamma measures delta. Gamma is the increase or decrease in an option's delta for every $1 move in the stock. So delta is not constant. Delta is always changing based on a few things, based on stock movement, based on time to expiration, based on volatility. Okay. And one of the things that we have to keep in mind is that the delta of an option at expiration is what? What is the delta of an option at expiration? There we go, Jake. Yes, it's one of two. It's one of two. It's either zero if that option is worthless and it expires out of the money. Okay, there's nothing to it. Or it is 100. 100 because, as we just said, if an option is in the money at expiration, what happens to it? It turns into a stock position. What's the delta of your stock position? 100, right? If you own 100 shares of stock and the stock goes up $2, you made $200. You own 100 shares of stock and the stock goes down $3, you lost $300. So somehow the delta of an option has to get from, let's say, where it is today to 0 or 100. Whether that delta is 30, 50, 80, whatever it is. It's got to get to 0 or 100. So gamma is what that measurement is. Now, few things about gamma. Okay. We look at gamma as a positive number. Okay. So unlike delta, where call deltas are positive, put deltas are negative, we look at gamma as a positive number. So whether you have a put or a call, if you own that option, you're long gamma, you're positive gamma. Whether you have sold a call or a put, doesn't matter, you are negative gamma. Okay. So long options have positive gamma, short options have negative gamma. Gamma, as you're going to see here in a moment, is highest for at the money options. Okay. Now, why is that? Okay. Here's a graph of that. Think about that. Why is gamma highest for at the money options? Anybody? Delta is the highest. Nope. Delta would be highest for an in the money, a deep in the money option, where delta would either be 100 for a long call deep in the money or negative 100 for a long put deep in the money. Yeah, it's got the highest probability of a rate of change at the money. Remember, we've got to have every option 0 or 100 deltas at expiration. So if we're right at the money, which is 50 delta, then we have that opportunity to go 50 down to 0 or 50 up to 100. So the further away you go out of the money or deeper in the money, just like what this graph shows here, the lower that gamma, the lower that rate of change in delta becomes. Okay. Also, let me go back a page here. The more time to expiration, the lower the gamma of that option is going to be. And why is that? Let's go back to what we just talked about a delta of an option having to be 0 or 100 at expiration. So if we were to look at this week's expiring options on December 5th, this Friday, we're going to see some pretty high gamma numbers because in the next 2 trading days, Thursday, Friday, I'm not even including today, but in the next 2 trading days, the magnet has to work. The magnet being the pull of delta to either 0 or 100. It's got to get there in 2 days. Whereas an option a month out, 6 months out, a year out, okay, doesn't have that time sensitivity for the delta to get to 0 or 100. So gamma is highest for at the money options and for the closest to expiration options. The more time to expiration, the lower the gamma. Okay. Now, when we have long gamma, when we own gamma, okay, what did I say that's due to? Okay, what sort of position do we have to have on to be positive or long gamma? Means we own options, right? Exactly, Kevin. Well, if we own an option, whether it's call or put, okay, if we own an option, we don't want the stock to just sit there, right? If the stock just sits there, then boy, the value of that option is really going to start disintegrating. So if you think about it, if we own an option, we need that stock to move. So positive gamma positions benefit from large price moves. Negative gamma positions, like when we sell an iron condor, for instance, that's a negative gamma position. It's delta neutral typically, but it's negative gamma. Well, when we sell an iron condor, what do we want to happen with that position? Exactly. We don't want movement. We want that stock to contract, stay in a range. Okay, so when I've got that negative gamma, which means I've sold options or sold spreads in our case, okay, we want that stock to just contract. If we've got long gamma, like if you own a straddle, you own a strangle, whatever it might be, you own, let's say, a call or a put spread where you're long, where you own the at the money option and then you're short the out of the money option. What do you want to happen? You need that stock to move, right? So does everybody understand that? Okay, great. I've gotten a lot of questions about the gamma squeeze, and we did go through this once before, months back, but a lot of people have been asking about it because if you're following just some of the social media out there and some of the cheddar flow bar chart, some of the others out there, they've been talking about gamma squeeze going on right now at certain levels in the S&P. What does gamma, is that a picture of a young Sib? I never had blonde hair. I definitely had the Tom Cruise Ray-Bans. That's a good one, Kevin. Um, but what happens with gamma squeeze? Okay, and before we get to the gamma squeeze, we are going to get to Little Lou. We're going to get to Little Lou here with the word gamma on the day. Just an easy word of the day here. And from what my son tells me, Lou is just like infatuated with this monkey thing that hangs down on her little play thing here. But let's go back to the gamma squeeze. Okay, if we think back to a few years back, and we actually had a period of time a few months back where a couple of the stocks, when the nuclear stocks got really popular and quantum computing stocks got really into the news, we definitely had some gamma squeeze situations going on. But if we definitely another animal lover. Oh yeah, when she was over for Thanksgiving, she loved the dogs all around her. At least in my head, I thought so. Anyway, um, if we remember back to the AMCs and the GameStops, right, when that was happening, what was the situation that unfolded there? Well, people on the internet, through Reddit boards, through Wall Street Bets, whatever it was, you know, they got together. When I say they got together, not physically, but just on these massively followed internet sites. Okay. And it became like a herd. And when I say people, okay, I'm just traders in general, not anybody I know, but just people, they started buying a ton. When I say a ton, we're talking about a ton of out of the money call options. Okay. So think about this right now. Okay. When GameStop was trading in I don't know the exact numbers, but let's say GameStop was trading $5, $10. Okay. And all of a sudden there's massive amounts of call buying up at the $15, $20, $25, $30 range, right? So the sellers of those call options are selling these things, collecting whatever premium they collected. But from a Greek standpoint, because those call options were so far out of the money, the deltas theoretically were close to zero. Okay, does that make sense so far? Kind of a couple step process here, right? So just like right now, if you looked at NVIDIA right now, which trading, call it 180, if there were buyers coming in of 220, 230, 250 strike call options, okay, the delta to those options very, very small, 4, 5, 8, 10 maybe, okay? But this was a self-fulfilling prophecy. So as the call buyers literally came in by the hundreds of thousands and millions of options. Well, if I'm a call seller, or if you're a call seller, okay, what's something you have to do to try and hedge your position, to protect your position? One of those things is I got to buy some stock, right, to protect a move to the upside. Sure, I can buy some other calls against it, but I've got to buy stock. Well, as the stock started moving higher, because all of the call sellers were buying stock, if they were trying to do this somewhat delta neutral, okay, they weren't buying a ton of stock because the delta of the options, of the call options they were selling, was so small. Okay, is everybody with me? I want to make sure everybody is following before I move on here. Okay, excellent. So when I say it's a self-fulfilling prophecy here, all the people that were selling those options and then buying stock were buying a little bit, a little bit, a little bit. But as the stock is now moving higher and it's being pushed higher because all of a sudden these stock buys are coming into a very unusual marketplace, in especially in the case of GameStop AMC, where there was not a lot of outstanding shares available to trade. So the markets were maybe a little thinner, and all these stock buys are coming in. They're pushing up the stock price. They're causing the stock price to move up. Well, the stock price is moving up, what's happening to the Greeks of those call options that we were talking about? Those call options that maybe were 2 delta, 4 delta, 8 delta, when they were originally sold, all of a sudden, the delta is changing as the stock is moving higher and maybe getting close to being at the money. The delta is changing. Why is the delta changing? Or what causes the delta to change? Gamma. Gamma. The gamma is causing that delta to move from 8 to 10 or 8 to 14 or 20 to 30. So as the short delta position of the call sellers is getting larger and larger and larger, they've got to keep buying more and more stock to cover the increasing negative delta position that these people had. Does that make sense? That is what a gamma squeeze is. A gamma squeeze is when you see a situation where the delta of an option all of a sudden explodes higher. Okay? And if you remember back to that time, a few years back with GameStop AMC, there was a big, massive, one of the world's largest hedge funds, Melvin Capital. They were, not well known for this in a good light, but they were well known for being at the top of the list of being these massive call sellers, and then just got literally liquidated because they had to chase the stock up. So that is this gamma squeeze. The gamma squeeze happens when there is a sharp increase in a stock's price. And that happens when, as we just talked about, increased call buying, the rapid rise in the price of the underlying stock. So a double whammy against those call sellers. And like I said, the hedging part of it, okay, they have to keep buying more and more and more shares of stock to hedge that position because that delta is increasing. Would it create demand for more and more long calls? It absolutely was. It absolutely would. Absolutely. So that was the situation in both AMC and GameStop here. But it was, I called it a self-fulfilling prophecy, but it's a self-perpetuating cycle because the call sellers, they are the ones driving up the price of the stock because they have to go in and buy that stock to hedge that position. And the higher the stock would move, the more stock they would have to buy. Self-licking ice cream cone. I love it. I love it. Hey, Mike Clark, because I am on a new computer here, can you email me not Slack it, but can you email to me the link to the wheel, please? So retail investors on those online forums we talked about, Reddit, Wall Street Bets, whatever it was, they kept buying and buying and buying. And you know the mentality, that herd mentality, that FOMO mentality. And a lot of retail traders have that, right? And they'll look up on the screens and watching CNBC, Fox Business, right? And they'll see that ticker going across and everybody talking about it. Say, I got to get in on this, right? I got to get in on this. Were the calls sold naked? No, Bill, they probably weren't sold naked, but the hedge against them, okay? Let's say I sold 100 calls, okay? 100 calls that were 5 deltas each, okay? A hedge against that, against a negative 500 delta position, would be to buy 500 shares of stock. Okay, does everybody understand that? Right, if I've got a negative 500 delta option position, I can hedge that by buying 500 shares of stock. Okay, to get me back to a neutral position, to 0 delta. Negative 500 from my call options, positive 500 from the stock that I own. Okay, does everybody understand that? Okay, so now let's say I've got that negative 500 delta of options, but I own 500 shares of stock, so it looks great. But what happens as the stock increases? What happens as the stock moves higher? What happens to the deltas of those call options? The delta of those call options then go from 5 to 10 or 5 to 15. So now all of a sudden, my original hedge of buying 500 shares of stock, okay, great. But now all of a sudden, if those deltas, let's say, are 15 on those call options, now I'm short 15 times 100 or short 1,500 deltas worth of options, and I'm only long 500 shares of stock. So now there's a discrepancy in this example of 1,000 deltas to get me back to neutral. So now I've got to buy 1,000 shares of stock when the stock has already moved higher. Okay, so now I'm squared up again. I've got 1,500 shares of stock, negative 1,500 deltas in my call options. Stock keeps moving higher. I still only have 1,500 shares of stock, but now all of a sudden, maybe the delta of that option is 25. So now I've got negative 2,500 deltas in options and only 1,500 shares of stock. Got to buy more stock to level it up, to even it up. So that's this self-fulfilling prophecy. That is the gamma squeeze. That is the gamma squeeze. Okay? Gamma squeezes are not sustainable. They do not last forever. Problem is, nobody knows. Nobody knows when that squeeze is going to end. And what can happen and what typically happens is the latecomers that are into that position, meaning, all right, they've sold the calls and they haven't bought stock yet, and they haven't bought stock yet, and they haven't bought stock yet. A lot of times it works out that, okay, when they capitulate and buy the stock finally to hedge the position, that's the top. That's the top. So now, and this will be what we wind up with. Let's say the stock has, in the GameStop example, let's say the stock has run up to 50. Okay. And you've sold 100 calls, which are now basically 100 deltas each. Okay. So you've got 10,000 short deltas in your call options. And you're like, oh my God, what am I going to do? Okay. So the short call sellers, they're buying stock relentlessly. They're covering this stock, and then all of a sudden, the bubble pops. So let's say they bought their stock even at 40 or 45 and got back to delta neutral. What happens when the bubble pops and the stock goes back down to 20, 25? Now, if you think of the math in the reverse way, now those options may only get back to 30 delta, 40 delta from being up at 100 delta. So now their option delta reduces down, let's call it to 3,000 if they're a 30 delta and they were short 100 options. But they now have that 10,000 long shares of stock that they had to buy $15, $20 higher. A rat chasing its own tail. I like that, Alice. Okay. So when you hear about or you see, you know, on CNBC, whatever, you read about it and you hear about a squeeze going on, please be really, really, really careful when you look at the implied volatility of these options that people are buying. And it may seem that the implied volatility is just so incredibly out of whack, so incredibly expensive. You're like, how can I not sell these things? Just be careful that you need to have that hedging. All right. All right. Let's get to our wheel today. Here we go. Our wheel is spinning. I'm dizzy. Is it JS Binga or Jennifer? It is JB Singa. I said JS, but it's JB Singa 7316. Are you in the house? This is a new winner. This is awesome. Like to see the new blood on the wheel. JB Singa, are you here? Let us know. I would hate to have to respin the wheel, folks. Ah, there we go. Wonderful. Wonderful. Congrats. There we go. All right, we're going to post up an email address for you. There it is right there. Shoot me an email at prosperswag@prospertrading.com and we will get you out some swag. All right, everybody. Thank you. Thank you. In the OpVal room, earlier today, someone in Zahor, I think you're in the room here, suggested doing a conversation on pin risk. Pin risk. I'll let you guys all stew on that overnight and think about that. And that will be our topic tomorrow. Jeremy, that's a great one as well. That is a great one as well. All right. So tomorrow we will be talking about PIN, P-I-N risk. Yep. Not pinning like, a college sweethearts would pin each other ahead of their engagement or hemming a dress or a pair of pants. This is pin risk. So you guys, if you feel the need, feel the urgency, Google it tonight. You can look into our education, our online education. There's info there on pin risk, but that's what we will be diving into tomorrow. And I will be back down live on the trading floor tomorrow. So with that, everybody, have a wonderful, wonderful evening, and we'll see you tomorrow.